You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernal. Last month's wildfires caused untold devastation for hundreds of thousands of people in Southern California. And with economic losses estimated in the hundreds of billions of dollars, public and private insurers will face significant financial pressure from yet another extreme weather event. On today's episode, we talk with Matt Palazola, Senior Analyst for Property and Casualty Insurance with Bloomberg Intelligence, about the size of insured losses from the wildfires, whether insurance companies will be able to meet all their obligations, and how the industry is adapting to the rising frequency of these extreme weather events. Stay tuned. Coming up soon, our interview with Matt Palazola, but first, a quick market update. The January core CPI rose 0.446% last week, the fastest increase in 2 years. It's hard to believe such an abrupt acceleration is representative of underlying trends, but it's also impossible to ignore. Core inflation has now risen at a rate inconsistent with the Fed's long-run target for 5 of the last 6 months. If nothing else, this further postpones any future Fed easing and increases the burden for upcoming months of data to convince the Fed price pressures are low enough to continue cutting rates. Traders found comfort in the relatively cool increases in the specific PPI components that feed into the Fed's preferred PCE deflator that will be released next week. Because of different methodologies and weightings, the CPI tends to run hotter than the PCE. Using the already released data, analysts are estimating a 0.3% increase in the January core PCE deflator. Certainly hot, but not as alarming as the core CPI. The bond market's initial post-CPI sell-off reversed after the PPI demonstrated some reasons for optimism regarding the PCE. Treasuries rallied further after retail spending fell much more than expected in January. Because of known disruptions from wildfires and extreme weather across the country last month, we are hesitant to deduce any signal from the weak report. Through all the back and forth, Treasury yields are close to where they stood before the CPI release. 10-year Treasury yields are anchored to 4.5% as we record this, though we think there is more risk of yields moving upward than downward over the next week. The bond market is pricing in roughly 1.5 Fed rate cuts through the rest of this year. The Department of Government Efficiency, better known as DOGE, continued its efforts to identify possible government spending cuts the past 2 weeks. Many of its recommended funding freezes and headcount reductions are being challenged in the courts. That's all for the market update this time. Now, our discussion with Matt Palazola. Our guest today is Matt Palazola, Senior Analyst for Property and Casualty Insurance with Bloomberg Intelligence. Matt, thanks for coming on the podcast.
Thank you.
Our topic today is the insurance market, particularly in the context of the devastating wildfires that have swept through Southern California in early January. Now, we're recording this on January 17th, and the fires are still not entirely contained. The human toll is heart-wrenching, and we're all hoping for a speedy end to the spread, but let's talk about the insurance market. Can you give some background to what the home insurance market is like in California? What is the share of homeowners that are insured, and what is that mix of public and private insurance?
The insurance market in California has many problems even before this. So I can't speak to exactly how many are insured versus uninsured. I would imagine the majority of homes will go insured. That will likely depend on whether or not you have a mortgage, because if you have a mortgage, you will need to have insurance. So most of the homes you're going to see are going to be insured, but then the mix, like you said, is very different. So in terms of market share, mutual companies lead in the home insurance market. So State Farm is kind of the big one, even though they have been non-renewing, they have the most share. Liberty Mutual has a lot of commercial insurance share in the state. Then you'll start to see the companies that I cover, which are the large public names like Allstate, Chubb, Travelers. They start to fill out that kind of middle tier. And then lastly, which is getting a lot of attention, is going to be the residual risk pool, the market of last resort, which is the FAIR plan. That is for homes and businesses. It insures about 4% of the homes in the state, about 15% of the homes in Pacific Palisades, about 20% of the homes in Malibu. So this FAIR plan is if you cannot get insurance from another source, you can go to this residual pool. This was set up by the government in the 60s, I believe, but it is run independently. It doesn't rely on taxpayer money, but it has the ability to assess insurance companies in a shortfall situation. It hasn't done that since the 90s. We do anticipate that it will run out of money in this event and end up assessing insurance companies this time around, though.
Now, my understanding is we've had an episode before on extreme weather events, and something that has come up is that certain regions of the country are more or less deemed uninsurable by the private market, maybe because it is too risky to extreme weather or because there is just a lack of information about the risks. In California, does the government do anything in terms of regulation to, well, under the motivation of encouraging insurance coverage, maybe put price caps on premiums or say that any home insurance has to include fire insurance, even if that insurance company would otherwise not give that type of coverage? Is there any regulatory intervention that the state of California does?
Yeah, so, and Will, you mentioned there's a bunch of states that are, having these extreme weather issues. And the thing about insurance is it's regulated on a state by state basis. So you've got every state with its own Department of Insurance commissioner, and they work with the companies in varying ways. So, what insurance companies, I believe the message I'm getting from a lot of them is even with climate change and even with the increased frequency and severity of extreme weather events, they can price for those weather events. They can't price for fraud. They can't price for the inflexibility of regulators. So, when you say uninsurable, I would say perhaps there's something, there's things that insurers will call uninsurable, like flood, for example. The majority of flood is written through the National Flood Insurance Program, so the federal government. But the home insurance market in California, they would like to be in that, and Florida as well. What they were finding first in Florida was there was so much fraud in the state that it was pushing costs up too much and making it untenable. What they were finding in California was some inflexibility on the part of the State Department of Insurance. So they were saying, yes, this state is wildfire prone. We need to incorporate the cost of reinsurance. We need to incorporate wildfire models in our pricing. And the state was not letting, it would think it was, I believe, the only state in the country that would not let insurance companies include the price of reinsurance, which is insurance for insurance companies, and wildfire models in their pricing. So that was really primarily the reason why insurers were pulling back in California, Allstate, State Farm, to begin with. It wasn't necessarily the fact that you had this wildfire risk. That doesn't help things, but the state regulators were just not working with the companies. They weren't allowing them to, one, include these things in the pricing, and two, increase their pricing when they needed. Back to that FAIR plan, the state has a lot of influence or control over the FAIR plan, what they can do. And the state essentially forced the FAIR plan to increase the limits on the policies that they write, the insured limits. And then the FAIR plan came back and said, well, we need higher prices to do this. And the state wouldn't give them the level of price increases they needed. So I think the biggest problem is the regulatory climate in a lot of these states.
That's a really interesting thing to put into context. Of course, these regulations are under the motivation of making it more affordable, but it can mean a kind of shortfall of coverage. At this point, again, these wildfires have not been entirely contained as of January 17th. What are the monetary estimates of insured damages so far? And can you put this into context with other extreme weather events like Hurricanes Milton and Helene, or even California wildfires in previous years?
It's interesting what's happening here is that one, in the event, it's taking a long time to contain, right? So we're kind of having this drawn out process of numbers coming in. Another thing is typically with a hurricane, even with other wildfires, we're getting more real-time data about damage to property and businesses. What was happening is, Wall Street was coming out, and analysts on the street, analysts like us at Bloomberg Intelligence, were trying to ballpark it, and we saw the amount of structures that got destroyed initially, and the numbers were like 10 billion. And then a day later, they were 20. And then things started coming out about 30 to 40. Just, I believe it was yesterday or the day before, CoreLogic, which is a catastrophe risk modeling company, came out with 35 to 45 billion of insured losses from Palisades and Eaton fires. There was other ones, but obviously those were the big ones. So I would tend to trust that, with the understanding that the event's still ongoing. I would trust the cat modeling companies numbers kind of more closely than you would, numbers kind of coming out of Wall Street, because we're just looking at a very limited set of data. These cat modeling companies are looking at satellite imagery and, kind of whole host of other sources that we just don't have access to. I am a little surprised that that came out this early, because obviously, I mean, I'm looking at it, the Palisades fire's 31% contained and the Eaton fire's 65. So CoreLogic came out with this with the understanding that it could go higher. But at their high end of $45 billion, this would put these fires among, I believe, the top 10 insured losses, worst insured losses in US history. It wouldn't go to the top of the list. There's some, 9/11 was an incredibly large insured loss. Hurricane Katrina would be much larger. But this is making its way to kind of a major insured loss event on par with like Hurricane Ian or things like that.
Before, when you mentioned the insurance companies that have a presence here in California, there are a lot of big names that I recognize. Is there any risk that some of them can't meet the obligations of these claims, or are they all big enough to absorb this hit?
They are all big enough to absorb it. There's a small amount of exceptions. So one, the FAIR plan that we talked about, the latest number I just heard, there's not public information on it because it is kind of this private entity. The last information I heard was they had about $373 million of cash. They have some amount of reinsurance. The amount I had saw at some point last year was like 2.5 billion in reinsurance. So you'd say that FAIR plan has less than $3 billion of claims paying capacity. Their exposure just in the Pacific Palisades zip code is $3 billion, and they have another 3 billion like in the adjoining zip code. So they have exposure far in excess of their claims paying capacity. That is something I'm worried about, but there's a number of mechanisms aside from assessing the insurers that they might be able to do. They might be able to raise debt, which is a new thing that California, a bill that just got passed, would maybe allow them to raise some debt and allow them to access lines of credit. And then they can also assess the insurance companies in the state. There is one public company called Mercury General that we don't actually cover, but is a California specialist. You just look at their market share in the state in home and auto. They have reinsurance. Should this event get to even the high 20 billions, let alone 40s, it would probably go through the top of their reinsurance, meaning they would exhaust all of their reinsurance. Even in that case, it would be a big earnings event for them, but not a solvency event. So, not really a solvency event for any major company.
Even if they do manage to stay solvent, they can access different things on their balance sheet to get the cash to honor these claims. Is there the potential for financial contagion if they have to really sell off a ton of securities that are focused in, I don't know, a small market, where that sale could kind of cause this ripple effect, even if they don't have to default on any of their claims, but of course how they access that cash does have downstream effects into the financial market.
I'm not too worried about that, Will. I don't. One thing just to keep in mind is that this is their business, right? When we analyze insurance companies, we build in, what they say, a cat load, right? Or we assume some amount of large losses. At the lower industry loss numbers, right? 15 to 20 billion, which probably seem low at this point, but at those amounts, the catastrophe loss would actually come in and within the the consensus expectations. So this would put it even double that. Would be a little bit of a strain, but again, you don't typically see insurance companies have panic selling assets. Like they have so much kind of running through and maturing that it's generally not been an issue that I've ever seen in my career. Certainly, there have been cases where insurance companies, smaller, maybe some even mid-sized, have gone under and have had to sell a bunch of their securities, but those events are not big enough. The securities that they hold, that amount is probably not big enough to dramatically move those markets. And just to take a step back, they hold about 90% in like high quality fixed income anyway. So if you were worried about a panic selling, which I'm not, but if you were, that would be the market where they hold the most.
I want to ask a process question because I've got to think that these claims take time to be filed and honored. So when someone files an insurance claim for an event like this, what are the odds that the homeowner recoups their losses? I know you talked about the prevalence of fraud in a state like Florida. How rigorous is an insurance company going to be for a claim like this when, if your house was in Pacific Palisades, you don't need to prove much. I would think that, the house has burned down. At the same time, you might be looking to get insured for all of your possessions, and that process takes a long time. So are insurers able to cushion the blow, so to speak, by kind of extending how long they pay out these claims?
From my perspective as an analyst of these companies, usually what happens is they kind of post the loss right away in the quarter, and then the kind of cash flow impact gets, I don't want to say buried, not like they're burying it, but it kind of just goes through the cash flow statement. I don't see that as much as I see that kind of upfront loss. So what the insurance company will do is they'll essentially book the whole loss in the quarter. Sometimes what happens is they'll have development on that loss. So they'll post a reserve for it, and the actual claims will come in higher or lower, and they will adjust it higher or lower. And we have seen that happen both ways. It can go down. In Florida, where there was a lot of fraud, what was happening is it was going up and up and up because of litigation around the claims. What I think is going to happen here, just in terms of process from kind of what I understand, because it gets a little bit in the weeds, there's going to be a run on insurance adjusters, right? So a lot of these companies have their own adjusters, but they might outsource some of that business, and they're just going to need a lot of them. So I feel like that is going to delay the process. One, I mean, obviously, as we've mentioned a few times, the fires are still ongoing, so it's hard for them to get in there. I think the people that are displaced, there's some policies will have some form of coverage for temporary housing or relocating. So they're probably already notified and in that process. But I think you're going to see delays in actually getting adjusters on the ground. Furthermore, you're going to see delays in getting materials in to rebuild. I think in a lot of these cases, and I don't want to speak too broadly, but when you have these sort of total loss situations, it may be easier to adjust in some cases. Like if the house is gone, the house is gone. The contents portion, I think, would require some work on the part of the homeowner to actually catalog the things that have been lost. So that takes a bunch of time. I think the state will probably try to push companies to expedite and get money in people's pockets as fast as possible. But I generally don't have a great sense of the amount of time that that process takes. But I think the companies will be acting fast. I think the fact that you have a lot of total losses could actually help the process, as opposed to a hurricane where you're seeing flood damage and then the adjusters are coming in, or the insurance companies coming in and determining whether or not coverage applies because you had flood or you don't have flood. That's less of a situation here. So, and I'm not saying that, for any individual, they're going to be guaranteed anything, but if you had a policy and it did have wildfire, which perhaps it could have been excluded by some policies, but if you had a policy and it had wildfire coverage, it was pretty obvious what happened. So I think there's a bunch of factors both helping and hurting the speed of the claims process.
What can we say, looking at past extreme weather events, what will the home insurance market in this area look like once, the wildfires are contained and there's the rebuilding process? Are private insurers going to want to cover these areas that are so prone to fires? Will they do it as long as it's for the right price, or are they going to be quite hesitant to get back into the market in these regions?
I don't see this helping in any way. I think the market, as we said before, the market was not doing well before. Perhaps I'm being a little too optimistic here, but the State Department of Insurance is trying to work with the insurance companies and to ensure the affordability of insurance. The state doesn't want people in the FAIR plan. And ideally, insurance companies don't want the state kind of taking their business or having this extra pool taking their business. They would like to have it themselves. But this doesn't do anything to entice insurers back. My optimistic scenario is perhaps this pushes the state to allow for better pricing, and then that brings companies in. In that way, I could see availability getting better, but I'm skeptical that that's going to happen. And I would actually take a step back, and what we were talking about before is when you have these mechanisms, when you have this residual risk pool, when you have Citizens, which is in Florida, these things actually artificially keep the price of insurance down. So as unaffordable as you might hear these things being, home insurance in California and Florida, they're probably still underpriced. So it's not incredibly attractive for insurers to go in at these prices. You need legitimate pricing on these risks. And until the state really allows that, I don't think you're going to see anything get better. I would think, in the vein of kicking the can down the road, like we kind of love to generally do in this country, you might actually see a state run mechanism like a Citizens come into Florida, California, or something with the federal government. I mean, Trump administration coming in and the government in California are clearly not aligned. So I don't know how quick you'd see the federal government moving to push, but I think the states are hesitant to allow the proper pricing, which then kind of kicks the can to the taxpayers in the form of some sort of state fund, some sort of federal fund, or in this case, the FAIR plan, which assesses insurance companies, and then those insurance companies can pass the cost on to consumers.
There are a number of reasons why housing is so expensive in California. But to put into context, the home insurance costs in California, is that really contributing to housing unaffordability because of the ways that California is prone to these extreme weather events? Or is, the cost of home insurance really just a small part of the whole picture?
It's probably a bigger question than my expertise, honestly, but I would say if you actually look at the average premiums for the state of California, they're not dramatically higher than other parts of the country. So I think people will tell you, yes, if I'm living in Pacific Palisades or I'm living in these fire-prone areas, my premiums are just out of control and I can't afford it, and it's causing me to rethink where I'm living. So I think selectively, yes. But if you look broadly in the entire state of California, I don't think the premiums are actually dramatically higher for the risk that you're insuring. That's probably because the state is keeping them lower. So I think the answer to your question is, in some ways, yes, but probably broadly no. I would say it's kind of more of a blame the insurance boogeyman than it being one of these main problems. Certainly a problem in some areas, but broadly speaking, I don't think so.
Matt Palazola, thanks for coming on the podcast.
Thank you.
That was Matt Palazola, Senior Analyst for Property and Casualty Insurance with Bloomberg Intelligence. I was pleasantly surprised to hear Matt's optimistic take on whether the insurance industry was at risk of financial contagion from these wildfires. But his belief that home insurance is generally underpriced sounds worrisome. If the private market can't effectively adjust premiums or coverage, there could be a lack of coverage that inevitably gets filled in by public plans that are funded through taxpayers in the end anyway. For those of you who missed it, our November 29th episode with Tom Doe looks at these extreme weather events in the context of the municipal bond market. Next week's data highlight will be the January PCE on Friday. Investors are cautiously optimistic the hot January CPI will not translate into a similarly worrisome increase in the Fed's favored inflation metric. The consensus estimate is for a 0.3% rise in the core PCE deflator, too high in the long run but not as bad as what was suggested by the CPI. FOMC participants will have the next 2 weeks to describe their outlooks in further detail before the pre-meeting communications blackout begins at midnight after the February jobs report. Fed officials have communicated a patient stance since their January meeting, happy to keep rates where they are until inflation heads downward, and see no labor market weakness that would warrant urgent policy easing. The following week, March kicks off with a couple ISM reports, February ADP employment, and the January JOLTS within the first few days. The data will help set the tone for the much more important February employment report on March 7th. After wildfires and cold weather depressed hiring in January, traders will be looking for a bounce back in payrolls to confirm underlying labor market strength. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.